The concept of socially, environmentally responsible investing is investing in a way that helps influence corporate behavior. Multinational corporations are not sustainable and never will be because they have a mandate for unlimited growth and maximizing wealth for shareholders. And usually that means at the expense of community, employees, and environment. So when people invest in a mutual fund that calls itself green or socially responsible, people need to understand that multinational corporations cause harm because of that mandate of unlimited growth within a ecologically constrained planet. We're already exceeding the ecological capacity of the planet. So the idea of unlimited growth and continued stock market returns, as we've seen over the last 60 years, is actually not physically possible unless we can borrow from another planet, which is unlikely. Growth is not bad. We need to decide what is it we want to grow. And I believe we need to grow healthy, sustainable communities. And that just can't happen in a multinational corporate model. There are publicly traded corporations, and there are privately held corporations, and there's a big difference because publicly traded corporations are owned by these passive shareholders who are demanding the corporation maximize wealth. When you buy a private company, you pay generally a price that is very grounded to the real wealth of that company. With publicly traded companies, when we purchase them in the stock market, we're buying them for these multiples that are just not grounded with the real wealth of the company. And keep in mind that the underlying real wealth of all of this is our ecological wealth, which we are in a deficit situation. So when we see a huge market correction in the stock market, it really can't come at a surprise. We know that this growth model, based on financial abstractions that trade at many multiples times the real wealth, that is only possible with the hope of investors thinking that growth will go on forever. One way that investors have been quite successful influencing behavior is through the shareholder dialogue activism or shareholder resolution process. And the most obvious examples of that goes back to 1980s South Africa divestment movement, where investors were voting with their dollars, filing shareholder resolutions, requesting companies to withdraw from South Africa at that time. That was quite successful. And from that, it grew into environmental concerns, asking companies to quantify their greenhouse gas emissions, to report that to shareholders, to see it as a liability. So it can cover many different issues of concern to shareholders. We've developed selection criteria that's based on the natural step, which is a set of sustainability principles that originated in Sweden and was brought to this country by Paul Hawken and Peter Senge. So that selection criteria includes, does the company have a sustainable business model? Are they making a product or service that is part of a healthy economy? It also includes the analysis of the company's product or service impact. So looking at where they get their raw materials, and do they have a product take-back program, and how they transport and distribute those products and services. We also look at the company's ongoing capital investments, because that tells us a lot about where they're putting their money. As you know, there's a lot of greenwashing in corporate America, so we have to cut through that. And one way is to take a look at where the company is actually placing their money. Is it in the same old way of doing business, or is it in a way that is more environmentally progressive? It's very important to find companies that understand sustainability from the CEO all the way down. Oftentimes you might find a company that has an environmental vice president who's tucked away in a corner, and it's not really embedded into the DNA of the company. So we're really looking for that kind of leadership that means the company is embracing environmental challenges and strategies throughout the company as if they're shifting their DNA. We're also looking for companies that have solid environmental management systems and resource efficiency. Resource efficiency, that's pretty easy. That's the low-hanging fruit, like turning off the lights and recycling. And then perhaps one of the most important criterion is under the category of liabilities. And what I mean by liabilities are greenhouse gas emissions. So we're looking for companies that are measuring their greenhouse gas emissions and are working to reduce them on a year-to-year basis. There is a scoring system behind the criteria. So of the 7 criteria that are listed, there are approximately 10 sub-criteria behind each one of those. And every one is scored with a number. And then the entire company is evaluated, and the scoring system produces one number in the end. And from that number, it determines whether the company passes or fails. Sometimes there's a gray area, it's right on the border, and there can be discussion at the investment committee level. Oftentimes, if a company is on the borderline, we may continue to watch it and see how it progresses over the coming year. Your money does have a vote, and your money is power, and you do have a choice. Whether you're in the supermarket or the stock market, you have a choice of how to employ those dollars.